Okay, well, good evening. Thanks for coming. I want to start off with asking a couple questions. What does long-term care planning mean to you? When you hear long-term planning, what does that mean to you?
Nursing home.
Nursing home?
Help with the cost of.
Pardon?
Help with the cost of either in-home or in a nursing home.
Or assisted living or something like that? Okay. Right. Yeah, that's what it means to most people. Second question. What questions do you have that you'd like answered in this class today?
What kind of things are covered in Medicare automatically?
Okay.
Like base Medicare and stuff that you...
I can answer that right away. It doesn't cover anything for long-term care. Medicare doesn't cover anything.
No, so there's no hospice benefit from Medicare at all?
No. Hospice, there's hospice, but for regular long-term care, Medicare doesn't cover it. That's a misconception. A lot of people think Medicare covers it. It doesn't. We'll get to that. What other questions do you... Yes, ma'am.
I just want to know more about the hybrid.
The hybrid policy? Okay. Okay, we'll talk about that. Anybody else? What questions? You came here for a reason.
I just came to see what it was all about.
What it was all about. Okay.
There's a certain...
What do I need to look at?
I'm sorry, I understand that there's a certain age when it's smart to buy.
Okay.
long-term
Okay.
care. I thought it was like 65 or
So
something.
you know it's usually 50.
50?
Mm-hmm.
Okay.
Yep. Okay. Any other questions? I'm not answering the question right now. I just want to make sure I do answer them throughout the course. Any other questions? Okay. All right. Well, there may be other questions as we go through this, right? And welcome to the people online. Thank you for joining us as well. All right. So I want to tell you a little bit about my experience with long-term care, my in-laws and my actual mom herself. And this is how I got interested in the concept. My father-in-law came down with Alzheimer's. And he happened to have been stayed in a hospital in a nursing home for probably 15 years before he died. Ended up in diapers and the whole thing. And his wife went broke paying for it because they didn't have any kind of insurance to pay for it. They had quite a bit of money at the start, but it all went to that nursing home. And the healthy wife just went broke. And she died shortly after he did. So that was a wake-up call for my wife and I that we should get some sort of insurance to help us if that happened so that the healthy spouse didn't go broke. Because the unhealthy spouse is taken care of, right? We're in the nursing home or assisted living or home health care. We're being taken care of. Thank you very much. But what about the healthy spouse? So years and years ago, we bought long-term care insurance for that very reason. That's what spurred us to do it. My wife said, look, we need to do this, and we need to buy the Cadillac plan in case that ever happens to us. Fortunately, we've been healthy. It hasn't happened. So, but that was our experience. Now, my mother had a different experience. She lived to 92, but when she had some heart issues leading up to that, and she flatly refused to leave her house. She wanted to stay right in her home no matter what. Well, she had 3 children, myself, my brother, and a sister. Fortunately, in our case, my brother and his wife were willing to actually sell their house and move into my mom's house and took care of her until she passed. So in my mom's case, she didn't really need long-term care insurance because the help was there. But it's those 2 experiences that really got my attention about long-term care. I've been in this business for quite a while, financial planning business for 40 years. But it was back when my father-in-law came down with Alzheimer's that I really got serious about the whole concept. So none of us really want to admit that we might need long-term care because it's pretty depressing, frankly, to even think about it, right? In fact, we all have lots of reasons why we don't plan for long-term care. I mean, I've heard these comments that you see up here a lot. Well, we planned for a shorter and healthier retirement. We didn't think we'd live that long. You can see the other reasons up here. I think my health insurance will pay. A lot of people think their health insurance or Medicare will take care of long-term care planning. It doesn't. Medicaid does, but you have to be broke before Medicaid kicks in. Literally broke. So the problem here is, and I want to just tell you, the main reason, I'm going to compare some risks. Give you an example. I think this will sort of surprise you, maybe. The chances in your lifetime of losing a home to a fire. How many of you have fire insurance in case your house burns down? Or if you have a home, condo or something, everybody's going to have fire insurance to get a mortgage. You got to have it, right? Okay? Well, the chance of you losing your home to a fire is 1 in 12, what is that, 1,200? The chance of having a car, how many of you have auto insurance? Chance of having a car accident is 1 in 240. Chance of needing long-term care, 7 in 10 of people over age 65 will require some type of long-term care. 70% of us who reach age 65 will at some point in their lifetime need some sort of long-term care assistance. It's a rather staggering statistic. As I mentioned, this is my contact info. Oops, sorry. Comparing risks. This is my contact information. I'm going to give this to you because I can't answer, I don't know any of you. So I don't know what your particular issues are or problems are or financing questions are or anything about I don't know. But if I don't answer your questions today, or if you just prefer not to ask the question here, but ask it in private, please feel free to contact me. There's no cost or obligation. You don't have to become a client. I've been teaching these classes here for 15 years. 4 or 5 different classes each and every year. This is one of them. Please feel free to contact me. I do this as, I feel it's a ministry. We've been members of this church for 18 years now. And I've been very blessed to be able to be the financial planner here offering these classes for all those years. So please feel free to contact me, email or a phone call. I'd be happy to answer your question. If I don't know the answer, I'll get it for you, okay? Okay. So what does long-term care planning entail? Most insurance policies will say, in fact, 99% of them will say the following. In order to qualify for long-term care insurance for a benefit, you have to be unable to perform any 2 of those activities of daily living. They call them ADLs, activities of daily living. And you see the list there. Eating. So if your doctor certifies that you're unable to feed yourself, or to bathe, or to dress yourself, or just walking, moving from one chair to another, transferring, toileting, taking medications, and the rest of them, or any cognitive impairment. If you have developing dementia, God forbid, or Alzheimer's, that in and of itself qualifies for most long-term care benefits. So that's the legal part. That's what the contract states. Any two of those activities of daily living, insurance, health insurance doesn't cover it, Medicare doesn't cover it. You either pay out of pocket or you transfer some of the risk of that to an insurance company. That's a choice we Americans can make. Okay? So what types of services are available to provide this kind of care? Right? So we got home health care, adult daycare, assisted living. You've heard of all these, I'm sure. Continuing care communities, hospice care, nursing home. There's a variety of different services that provide for this, and they all cost different. What are some of the costs? Let's take a look at them. These are national average costs. It's more expensive in the Washington, D.C. area, for example, than it might be in Charlotte, North Carolina. But these are national average costs. So home health care, about $5,000 a month. Adult daycare, $50 to $100 a day. Assisted living, $57,000, almost $58,000 a year. Continuing care communities. You know what those are? You know what a continuing care community is?
Is that where you start in like assisted living, but as you get more ill, you move up into like...
Yes, yeah. I have several. We live currently we downsized 6 years ago from Reston after 35 years to a community called Dominion Valley out in Haymarket. And we had a choice of housing out there when we moved. All the way from a big old fancy house like we used to have, or to sort of like I guess they call them a multi-level, or what do they call those things? It's called the Georgetown where we live. But it's two houses sort of attached together, and they're much smaller than the big houses, right? And then they're condos. Now this is a gated community, and it's sort of a nice community, and so they were all nice. All the choices were nice. But we decided that we were going to do the condo route after many, many years of living in the big house. Why? Because we never wanted to move again. The move was so chaotic and so stressful that my wife said to me, Mike, you don't enjoy puttering around gardens and mowing the grass, and that's just not you. Your dad didn't do it, you don't do it. She says, I don't particularly enjoy that either. She says, and we hated the move from the big house, right? It was a horrible, why don't we just move right into the condo, and that way we'll never have to move again. And we hope we won't. We don't think we ever will have to move again from that community. Now, a continuing care community, if we did move, we've had several people in our condo building get so sick from a fall or just from heart attack or stroke that they had to move even from the condo. And they moved into a continuing care community. There's several of them around. And what they're doing is they start off they paid about $300,000 up front. They sold their condo, took that money and paid $300,000 to get in. And it's going to be $4,000 a month now for the rest of their time there, according to the contract. And that pays for everything, food, everything. And as they move, as they get sicker and sicker, they'll move from what they call light care to medium care and then heavier care. It's a succession of planning. So that's the continuing care, but it's very expensive, $400,000 to $600,000, whatever, and then a monthly fee. So who pays for this care, right? So let's say you need the care. Who pays for it? Well, it's not Medicare, I've already mentioned. Medicare doesn't cover that. Medicare is just for your regular doctor bills and regular hospital, but doesn't cover long-term care at all. Medicaid, as I mentioned, they'll pay for it, but you have to be broke, you have to run out of money before Medicaid will kick in. If you happen to be a veteran, and then there's just the small amounts of benefits. I'm not an expert in that area, but if you are, I can get information for you. But it's just minimal if you're a veteran. And then, of course, if the other choices are personal income, out of your personal income and assets, or insurance. So it's either out of pocket or insurance. A lot of people choose to self-insure. Oh, it'll never happen to me. We'll never need it. And if we do, we have some money. I'll cash in my IRA, and hopefully that'll be enough to carry us. A lot of people feel that way, and they have every right to feel that way. On the other hand, a lot of people say, no, no, no. I want to transfer some of this financial risk from my shoulders to an insurance company's shoulders, just like I did for life insurance, just like I did for health insurance, my auto insurance, my fire insurance. I transfer risks all the time. Why not consider transferring the biggest risk in the world, really, which is it's like a living death. My father-in-law, when he was in that, I can't tell you just how, I don't know if any of you had experience with people who have had Alzheimer's for any length of time. But it was the most depressing experience I've ever been through, to see my father-in-law go through that. And I just wish that they had had long-term care insurance so that the wife didn't go broke paying for his care. So what's the impact on the family member if he or she is providing the care? Well, I can tell you that in our family with my mother, the impact on us was great. Not only did my brother, as I mentioned, and his wife choose to sell their house and move in with my mom, it was a huge impact on them, of course. But we also participated in helping, had to take off time from work. It was a big strain. We loved her, and it wasn't a burden, but the impact on us emotionally and financially, as you might understand, was great. So, and what about the financial consequences of paying for this long-term care? Think about it. I'm going to ask you in a few minutes, I'm going to ask all of you to ask yourselves 3 questions in a few minutes. Before we get to those 3 questions, I want you to think about the financial consequences of funding long-term care out of your own pocket. First, of course, there's the tax implications. What does that mean? Well, what if the only way you can access money to pay for your assisted living or home health care or your nursing home is by cashing in money out of your IRA or your 401k or one of your retirement accounts? None of that money's ever been taxed. So when you pull it out, I'm sure you know, you'd pay tax when you pull it out. So could be a huge tax implication. Liquidity. If you have substantial savings and you use all that savings up, that liquid savings up to pay for long-term care, and then you're in a position that it's not too comfortable financially. Market timing. What if when you need the money to pay for these services, the market's way down like it is today? We're in a bear market right now, as you all know. 20% down from the most recent high is a bear market. It's the definition of a bear market. We're in it now. What if you needed to pull money out now when you're down 20%? Not good. And finally, loss of future income because you can no longer work. So I suggest that everyone in this class ask themselves 3 questions. 3 questions. Okay? Don't have to answer it. Just think about it. How would I pay for long-term care if I needed it? Or my spouse needed it? Second, what funds would I have to use? Savings, IRA, 401k, brokerage account? And third, will I have enough? And of course, we don't know how long. Only the good Lord knows how long we might need it, if we need it to begin with. So now let's look at 2 types of long-term care insurance that are available to we Americans today. There are only 2 types. The 2 types are traditional long-term care insurance, which we'll talk about, and then the hybrid policy that the lady here said she was interested in learning more about. So let me give you some background here. The traditional long-term care policy is the one that's been around the longest. It's the one you're most familiar with if you looked at it at all. It's where you pay a monthly premium, you pick a daily benefit that you want the policy to pay if you need it. You have a waiting period of, say, 30, 60, 90 days before it kicks in. You pick a length of time that you want the benefit to pay, 3 years, 5 years, lifetime. And the premium you pay, of course, is going to be dependent upon the choices you make. Whether you want a lifetime or a 3-year or a 5-year benefit, whether you want a 30-day waiting period or a 180-day waiting period before it kicks in, the benefit kicks in, right? Whether you want cost of living built into the contract or not. Those are all features that ultimately determine what the premium will be. What was really interesting, and those policies have been around forever. But guess what? Most people don't buy them. So insurance companies, about 30 years ago, when they recognized that people weren't buying it, even people who reasonably should be considering it and buying it, weren't buying it. So insurance companies wanted to know why. So they sent out surveys to everybody. Why aren't you buying? What are your top 3 reasons for not buying long-term care insurance? And they got an overwhelming response back from people. And they took a look at the questions and boiled it down. The number one reason that people gave was what, do you think? And it was overwhelming. Pardon?
Too expensive?
No, that was number 3.
I didn't think they needed it.
Yes, they didn't think they'd need it. And if they didn't think they'd need it, and the number 2 was, and in fact, it was wrapped up in number 1 because it drilled down with, said, why do you feel that way? It was, well, okay, if I buy it now and I never need it, all that money is down the rat hole. I paid for it for 20, 30, I bought it when I was 50, and now I'm 80, I've never needed it. And so all that money is wasted. That was the number 1 reason. And not only that, number 2 reason was, what if I die before I need it? I've spent all that money and I die. My spouse gets nothing, no one gets any of that money back. 3rd reason was the cost. So let's look a little bit at the traditional policy and how it works. I just mentioned some of this. The daily benefit elimination period, that's the waiting period before it kicks in. The length of the benefit, inflation protection. There's something called a shared care rider, not enough time to go into that.
Can you explain the elimination period?
Elimination is waiting period. You self-insure you select the period of time that you would self-insure before the benefit kicks in
Okay, so as soon as you run into trouble, you have to pay for that for a certain amount.
on your own. Yes, sir. And that would be like 30 days, 60 days, 90 days, or whatever, right? The longer the waiting period, the lower the premium. Make sense? Right. So those are the main features of the traditional long-term care policy. Okay? Only 10% of people who, I think all of us would agree, probably should consider buying it, only 10% of people buy it for the reasons we just talked about. We bought it because we had the scare of our lives because of my father-in-law coming down with Alzheimer's. Otherwise, we might not have bought it either. So, insurance companies being creative, about 25, 30 years ago, after getting the results of the survey back, said, wait a minute, Americans aren't buying this thing. They need it. 7 out of 10 Americans need some sort of long-term care after age 65, and yet Americans aren't buying it. And they're telling us why they're not buying it. We've got to do something. Enter the hybrid policy. That's the other option that we're going to talk about. It's the most popular. Oh, by the way, before we go to the hybrid, the traditional long-term care policy, there's no guarantee that the premiums won't go up. In fact, that's what's been happening. If any of you know anybody who's had long-term care insurance for any length of time, they will tell you that their premiums have increased over the years. And why is that? It's happened because way back when long-term care insurance first came out, the actuaries, the people who figure out who's going to need it and how long are they going to need it and how many are going to drop the policy before they need it, they're paid big bucks to figure all that out. Well, they underestimated. They screwed up, to put it in the vernacular language. They messed up. And they found out, after not too many years, that people weren't dropping their policy as soon as they thought they would, that they needed long-term care longer than they thought they would before they died. And as a result, insurance companies were facing a financial strain because they're paying out more than they'd anticipated they had to. So what they do, and they still do it today, when faced with that dilemma, they are required to go to the state insurance department. So if we're in Virginia, they'd have to go down to Richmond, the insurance company, and they petition, they request what they call premium relief, is what the industry calls it, premium relief. And they have to justify to a panel of people, experts, why the insurance company needs a rate increase. And they don't just pick on each individual. It's going to be for everyone that's in that company with that policy. So that's happened numerous times with Travelers, with John Hancock, with Genworth. You've probably heard of some of these companies. Rates have gone up. And they'll continue to go up over the years. It's another reason why people today, even less people, are buying the traditional long-term care policy. Because they bought it when they thought they could afford the premium, and all of a sudden now to keep the policy, they got to keep paying more and more. Okay? So traditional long-term care policy, it's still viable. A lot of people still buying it, but they're not as many as they should. So enter the hybrid policy. So the insurance company, being creative, as I mentioned, said, look, here's what we're going to do. We're going to create a policy that answers the objections of all the people, that all the people gave for not buying the traditional. First of all, we're going to give them the option of getting their money back, changing their mind, if you will, after 10 years. After they've had it 10 years, they change their mind, we'll give them 100% of their money back. And if they want a prorated amount, let's say after 5 years, we'll give them a pro rata amount back. In other words, they have a chance to get their money back ultimately. That's number one. Number two, let's create a policy where if the insured dies, never needing the long-term care, his spouse receives more money tax-free than what they put into the policy. And third, let's make sure that whatever they put into the policy, the amount of long-term care benefit they're going to get is at least 2 or 3 times as much as what they put into the policy. All tax-free when it comes out. Why is it called a hybrid? Because this policy is a combination or a hybrid between a special kind of life insurance policy that pays the death benefit and a long-term care rider that pays the long-term care benefit. And those benefits come out tax-free if needed, as does the proceeds of the life insurance comes out tax-free. The hybrid policy, I'm going to tell you a little story about the first sale I ever made of the hybrid policy. Only because I think it's amazing, not because I'm amazing, but because this woman was amazing. She attended one of my classes, not here, it was George Mason University where I teach classes to senior adults. She came in after the class for a consultation, and she says, Mr. Bay, I'm 70 years old, I'm a widow, I'm rather well off. I have about $3 million worth of net worth. I'm rather well off. My kids are all grown and they're doing well, thank you very much. She says, but I wanted to purchase long-term care so that a nursing home or assisted living never got any of that money because I want my kids to get everything that my husband, who passed away, and myself have worked so hard to get. I want them to get every penny. My first reaction to her was, I wish you were my mom. But she said, the problem, I said, well, why haven't you bought it? She said, well, I applied 3 years ago, but I had a stroke 5 years ago, and 3 different insurance companies turned me down because of that stroke. As you can see, Mr. Bay, I'm perfectly healthy. I walk around and everything's fine. She said, they told me to come back in another 5 years, and if I'm still healthy and walking around fine, they'll reconsider offering the policy to me. She said, then I came to your class and I heard about this hybrid policy. She said, do you think I'd qualify for that? Now remember, this was my first sale on this. This is going back 20 some odd years. And I said, I don't know. I said, how much long-term care insurance or dollars would you want available if we can make this happen? She says, $1 million. I want $1 million of money sitting there available to use for long-term care if I ever need it. $1 million. She says, you said in the, and so that's when I had to, I explained it in the class. I'm going to explain it to you in that class. I'll explain it to you now how this works. Unlike the traditional long-term care policy where you pay monthly premiums or annual, however you want to pay your premiums, unlike that, the hybrid policy is repositioning current assets into the policy. It's not paying premiums. It's repositioning assets from a CD or a brokerage account over into this policy. And remember, you can get the money back ultimately if you want it, right? It's repositioning money. What she did, she heard me say that in the class, she says, I've got money to reposition. How much money would I have to reposition into this hybrid policy to get $1 million worth of long-term care insurance? So I don't know, but I'll figure it out. I went to the insurance, several different insurance companies, came back, said she'd have to reposition $300,000 into this contract, which she could get back after 10 years if she ever decided to get it back. And it provided $1 million worth of long-term care insurance if she needed it. And the death benefit was $450,000. So she put $300 in. Oh, she says to me, I came back with that information, and she says, $300,000, I can do that. I said, where are you going to get it from? Well, I have $500,000 sitting in CDs that's earning nothing, hardly. So she says, let's see if I can qualify. So I had no idea if she could qualify. The good news is she did. She thought I could walk on water. She just thought I was wonderful. I said, ma'am, you're the wonderful person. You're the one who wants to take care of your kids. So we got the policy issued 20 years ago. She was 70 then. She died when she was 89, never needing it. Her kids got the $450,000 tax-free. But she had peace of mind. She told me that. It gave her peace of mind to know that the money that she and her husband had created and built over the years, that God had blessed them with, that 100% of it would go to their kids. So that's the hybrid policy. Now, let's bring it down to reality here. If you're going to, you don't want to reposition any money into a contract like this if you need it to live on. This is money that you don't anticipate needing to pay the bills, because you shouldn't do this if that's the case. You should, if you're going to do it at all, do the traditional long-term care, which is a monthly premium, and you don't have to reposition chunks of money. But you say, well, what if I wanted to have that $1 or $500,000, but I don't want to put all the money in at once, reposition all at once? Well, the newer versions of these policies, the hybrid policies, will allow you to reposition it over a number of years, 5, 10, 15, 20 years. Rather than one lump sum, you can reposition periodically over time. I have one client, for example, she and his wife, or husband rather, each wanted to have $100,000 repositioned into these policies. Each wanted to have a policy. But they didn't want to put the $100,000 in all at once. So they decided for them, they were going to put in $20,000 a year for 5 years each. So that's what they did to get the 100 in. 5 times 20 being 100,000. That 5 years is now passed, so their policy is paid up. Now let me tell you some of the differences between the traditional and some other differences between the traditional and the hybrid. First of all, there's no waiting period, no elimination period for the hybrid policy. Unlike the traditional, where there's a 30, 60, 90-day waiting period where you have to self-insure, there's no waiting period with these. You're contractually guaranteed never to have an increase in premium. That's huge. Because remember, the traditional, they can increase the premium in half. No increase, it's a contractual guarantee. You can build in cost of living just like you could with the traditional. So the way these hybrid policies are marketed, they're saying, look, if you buy the hybrid policy, you're guaranteed to get some sort of benefit. You want money back, you get it back. You pass away, the beneficiary gets more than you put in. If you need long-term care, it's there. So that answers all the objections that Americans had with the traditional, right? Now, not everyone is in a position to have assets they can reposition. I know that. So when I sit down with my clients, I tell them about both just like I'm telling you about both. And not everyone is a fit for the hybrid, right? And so there's at least an alternative if they wanted to do it. I have some clients who have the traditional, and they hear about the hybrid, and they felt they didn't have enough of the traditional, so they buy a hybrid on top. They reposition some money into the hybrid. What's the cost of the hybrid policy? What's the cost of the hybrid policy? Very simple. It's lost earnings on the money you reposition, because that money that you've repositioned isn't growing. Why? Because that money you've put in there has created 2 other buckets of money, the life insurance bucket and the long-term care bucket. But the money you've repositioned is flat. So you put in $25,000, that's a minimum. It stays at $25,000. So you don't want to put money into this to try to get, this is not a retirement plan. This is not a brokerage account. You're not putting it in there to grow the money you reposition. No, you're putting it in there. So if someday down the road you need long-term care, it's there. That's why you put it in there. So I've talked a lot of people out of the hybrid policy because I badgered them. I said, are you sure you can live without this 50,000, this 100,000? Is this money that you sort of put away thinking that if I ever need it for health insurance or if there's a medical or emergency, then that's one thing. But if you need it to pay the bills or you feel you need it, you don't have emergency funds set up, right? You don't have a reserve for emergencies. And their financial situation is not right. I talk them out of it. Because that's the worst thing that I could do to them, is talk them into something like that when they really can't afford to reposition that money. And unfortunately, most Americans are not in that position. So they go with the traditional long-term care if they go at all. But I'm just being brutally honest with you. Those are the only two choices available to we Americans. You either self-insure, or you do the traditional, or you do the hybrid. That's it. Yeah.
What guarantee with the hybrid, when you put money in investments in the bank, if that company goes belly up, there are protections for your cash that's in there? Insurance companies have issues from time to time. What happens if something happens?
There are state insurance agencies that back it up. Just it's not FDIC, but it's a state version of it. So all companies have to contribute certain amounts of money into this insurance company that backs them up, and they'll come in and bail them out. Typically, what most on the banks many more banks have failed than insurance companies over the years, many more. But those insurance companies that have had troubles, most of the time, I'd say probably 80% of the time, other healthier insurance companies will buy that book of business, take it over. But let's say that doesn't happen. That's when the state insurance agency will take over and make you whole. Good question. Before we move on, I'm going to try to get through the slides fairly quickly and then answer any questions you might have, because you may be having some. So, okay, here are the main reasons why people do buy long-term care insurance. If single or widowed, to protect the assets for self should you recover. Protect the family from impact of needing care. Ensure the ability to keep financial commitments and peace of mind. Tell you another interesting quick story about the hybrid policy. I was having lunch with this couple, been longtime clients of mine in the investment area. And I brought up, they didn't have long-term care insurance. He was 52, she was 50. And I just brought it up. I said, I've done your financial plan. I notice you don't have any long-term care insurance. Is there a particular reason why you don't have it? Well, Mike, you know our financial situation, we're rather wealthy. I said, yes, I know that. They live in this huge mansion and they got all kinds of money. So we feel we're self-insured. We got enough money to do it. They had $10 million of net worth. We feel we can self-insure. I said, sure you can. You absolutely, that certainly makes sense. But then I asked a question. I didn't know I'd get this reaction, but I asked the question. I said, what if the long-term care costs you guys, say, $3 or $4 million over time? You live a nice long time like my father-in-law did. Does it concern you at all that the kids aren't going to get that $3 or $4 million? The husband said, no. The wife said, it concerns me. And she looked at her husband and says, that concerns me. It should concern you. And they got in a little mini argument right there at the nice restaurant where we were. They ended up buying the hybrid policy, one on each of them, $100,000 into each. They did theirs over, what did they do it? 2 years. Put 50 in each for 2 years to fund it up. They've now had it for 8 or 9 years. So everyone's different. All right, so
And with the hybrid, that's a kind of a one-time cost. You pay that value, you bring on your death benefit, and it provides a certain amount of coverage.
correct. It could be one time, or you could, if you don't have the money, as I mentioned, to do it all in one time, you could spread it out over a number of years. I have some clients, younger clients, who are spreading it over 15 years. To get the amount of money that they want in there, they're just repositioning money incrementally over a 15-year period, which can be done. Or it could be a lump. Pardon?
Is that the maximum number of years that you can spread it out?
15, I think the max is 20. Yeah. Depends on the company. I'm an independent advisor, so I can represent any company in the nation. But it depends on the company. Typically, they're 20 years.
What happens if you're doing that over 5 or 6 or 10 years, and something would happen to you and you need the benefit before you fully funded it?
Then the benefit's there. So it's, right from day one, there's a benefit there. It just grows with cost of living. So let's say you take out the policy today. Depending on how much you put in, there's going to be a death benefit available immediately, and there'll be a long-term care benefit available immediately if you needed it, the coverage today. And then that benefit, the long-term care benefit, increases each and every year with cost of living. 3% typically is the cost of living increase. So for example, this last couple that I was telling you about, who ended up putting, not the last one, the one before that, where they each put in $100,000 over 5 years. By the time they were 52, 53 as well. By the time they were 80, when more likely to need it, their long-term care started off their long-term care benefit from day one, when they put in the first 20,000, when they put in the first 20,000, their long-term care benefit was something like let's see, $150,000 or something like that. So it's leveraged up immediately from what you put in. By the time they were 80, with the wives, it was almost $1 million worth of insurance available to her. That's what she was concerned about and he was concerned about. What about when we're more likely to need it in our advanced years? What's the benefit going to be contractually? And it's guaranteed. So that's what they liked. I am not here to sell the hybrid policy or the traditional long-term care policy. I'm not trying to talk anybody into buying insurance. Rest assured of that. If you're comfortable self-insuring, taking that chance, maybe you've got family members that can help you, then don't buy it. My job is to educate you on what's available, if you choose to.
So on that hybrid, if as they're funding it over the years, is the amount going up, like your benefit is
Yes.
going up too?
The benefit is going up. That's why it went from original, I was just saying, from 100 and some odd thousand year one to age 80, the benefit was up close to $1 million
Right,
because of the cost of living built into it.
okay. So whenever you purchase it, like, say, you put 20,000 in, they're gonna say, okay, you have 100,000.
Yes, immediately.
If I need to use it in 2 months.
You get the 100,000 available to you.
100,000. Okay, but then when I put in more next year, it's going up.
Correct.
another-
Exact, whatever. It depends on your age, right, and the whole thing. So we run illustrations. If you do this with any advisor, whether me or anybody else, make sure you get them to run an illustration for you, showing you the guarantees in the contract. So it shows you exactly what you could expect to receive if you ever need long-term care from day one all the way out. So there's no guesswork as to what the benefit would be. Okay? All right, so what about the premiums for long-term care insurance? Well, Premiums are going to vary depending on your age. You already know this, I'm sure, your gender, your health, the type of insurance. And that's true with the hybrid too. The amount of your benefits is going to depend upon your age, your health. You do have to qualify health-wise, by the way, for either one of these, which you could expect, the traditional or the long-term or the hybrid. What's interesting about the hybrid is you don't have to go, there's no medical exams or blood work or anything like that, which, by the way, is required with the traditional policy. What happens with the hybrid policy, with all the companies I've ever talked to, is it's all done with the underwriting is all done with a telephone interview, typically a half-hour, 45-minute interview with a nurse at the insurance company. And you're given a questionnaire to fill out with all the questions that the nurse is going to ask you. So you know beforehand exactly what you're going to, how much medication you're taking for this, and when's the last time you went to the doctor, that kind of thing. So you have the questionnaire already filled out, you'll be on the phone, and the insurance company makes a decision as to whether they'll accept you or not based on your answers to that in that interview. So that's sort of neat. It's a much easier process, I guess, is the point I'm trying to make.
What is a medicine defined as?
Pardon?
What is a medicine defined as?
Medicine?
Yeah, I mean, is it something the doctor prescribes, or is it a supplement?
No, not supplements. It would be medicine, like blood pressure medication, cholesterol medication, or any other, anxiety medication, something a doctor prescribes. Yes, sir. Yeah, not supplements.
Yeah, and my question is doctors can also prescribe supplements, but that doesn't necessarily make them medicine.
No. And you'll actually have most of the companies, that's a great question, because most of the companies, even before you decide you want to pursue an application, will give you a long list of the medications that are deal breakers. So you'll know beforehand, you can look down and say, oh yeah, it doesn't apply to me. Or yeah, this one got me. Yeah. Okay, so I went through that rather quickly, but I wanted to get through it because you may have some additional questions. And if you don't, we go home early. But I'm here as long as you'd like. So any questions? I want to go over this fast. I promised the 2 or 3 that were here early that I'd get through the slides pretty quick so that I could answer any questions you might have that I haven't covered.
I'd like to sort of understand hypothetically what the cost would be. Just pick a hypothetical age of.
For the traditional, you're talking about the traditional or for the hybrid?
Well, what does it cost for traditional?
The traditional obviously depends on all these factors we talked about, right? Your age, your health, because if your health is not so good, the premium could be higher than if you're really healthy.
And that requires a physical.
That would require a physical or paramedical. It depends on the length of benefit you want to have, a 3-year, 5-year, depends on all of those things. But let me give you a typical, because I know you're trying to get a ballpark, right?
That's exactly.
Sure, it makes sense. Let's say most people, when they buy the traditional policy, will buy the following type of plan. They'll buy a 3-year benefit because the average length of time in a nursing home is 3 years. So they'll buy a 3-year benefit. They'll buy a $200 per day benefit, $200 a day. The average cost of per day in a assisted living or long-term care is probably higher than that, but I'm giving you an average, say 200. In New York City, the cost for a daily benefit for assisted living is more like $250 a day, but let's say 200, because we're not talking about transferring 100% of the risk. All you're trying to do is transfer some of this financial risk off of your shoulders to the insurance company to give you some relief if you ever need it financially. Here's the average is 3-year benefit, $200 a day, 3% cost of living feature built into it, and a 90-day elimination or waiting period before the benefits kick in. Let's say if you're 50 years old and you buy that policy, and please don't hold me to this because I'm just giving you, and you buy that policy, I would say it's probably $2,000 a year. Ballpark. That's if you're healthy, pass the exam, and so, but don't hold me to it because it might be 3,000 or it might be 1,500. Okay? Yes.
The premiums can also increase as you get older.
That's what. No. Well, not as you get older. It's if the insurance company decides.
So it doesn't matter about age. It's just if
No.
the insurance company decides to do a rate increase, you're subject to whatever that rate increase could be.
That's correct.
Okay.
If the insurance company decides to rate, right. And often what they'll do, here's what happens typically. Let's say you bought this policy. You're paying your $2,000, right? And you've got your 3% cost of living, you've got your 90-day waiting period, and you've got a three-year benefit. So now your insurance company, this XYZ insurance company, comes back and says, whoops, sorry, we're going to have to increase your rates. It's not just yours, it's everybody's. Okay? And we're going to give you some options. We realize you don't want to have to pay more premium. So what we're going to do is give you some options. Do you know what some of those options typically are? Pardon? Reduce the benefits. Yeah, maybe instead of 3% cost of living, now it's 2. Or maybe instead of a 3-year benefit, now it's a 2-year benefit. Maybe instead of $200 a day, now it's $180. And you can pick and choose and pick some of those lower benefits. Of course, the premium might remain the same or just slightly above where you are now. I always counsel my clients, if they can afford it, to keep what they got, because the reason the insurance company is coming back to you and asking for a rate is why? You've got a great plan, babe. You've got a great plan. And they know it. And they can't afford to keep that plan in force unless you pay the additional premium. And so if you're really concerned, and you were when you bought the policy, about long-term care and having sufficient benefits, if you can afford it, keep the policy. And most of the time, that's what people do. The increases aren't every year, but they could be every 4, 5, 6 years. I've had it happen every 4, 5, 6 years to some clients. Genworth right now, one of the biggest companies selling long-term care in the past, they don't sell long-term care anymore, but for all the policies that they've sold in the past, they just are in the process of having another rate increase. So, I mean, does that answer your question pretty much? Gives you a ballpark.
Yeah, so that's 50, that's the ideal age. What if we were 60?
Maybe 3,500?
3,500 start.
Yeah. Pretty big increase. Okay. Any other questions?
Well, hypothetically, then 70. I'm
Trying to get it. Well, it goes up quite a bit as you get older, of course. And of course, remember, you have to qualify. And as you get older, we have a few dings here and there, right? Typically. So it might be much more expensive depending on your health history. But if still healthy, maybe 5,000. And progressively higher as you keep going.
My parents both had the Genworth policies, almost exactly what you were talking about.
Oh, no kidding.
My mother ended up using it for 3 years for home health care after she broke her hip. But my father died without ever using his, so we lost all the money of his. So you're saying the only option they came up with for that risk with the traditional was the hybrid. There's never been any other thing done to the traditional. Wow. We lost $250,000. Wow.
Oh, yeah.
They had paid for it for almost 30 years.
Remember, that was the main reason why people didn't buy it in the survey, right? I'm never going to need it. And therefore, the money's down the rat hole.
It helped my mom. It definitely helped.
Oh, yeah, yeah.
He got sick and died so fast he never needed it.
Right, right.
So it was like all that money. So the hybrid's interesting.
Oh, it's very interesting for those people who can have the assets to reposition. It's very interesting. This is by far the most popular type of long-term care insurance today. I've never had anyone ask for a refund because I drill it in their heads. I said, look, if you're buying this policy because you're so enamored with the fact that you can get your money back, you're defeating the whole purpose of this. You don't want to do this. You only want to do this if you want to make sure that you have sufficient money available if you need long-term care. That's got to be your main motivator, not being able to get the money back. It's sort of nice, and there's nothing wrong with it. It's a nice feature, no question. But don't do it if you are even slightly thinking you might want to take the money, need the money back. Don't do it.
Do they both allow benefits to be used for home nursing care? I mean, do they have the same ability to use the money for the same types of things?
Yes. Home health care, assisted living, nursing, absolutely. Yes. No waiting period. That's key.
Yeah, that was huge.
That's huge.
A lot, because it was about $200 a day for.
Yes.
And that we finally did stop doing 24/7 and just did certain periods of the day.
Just got too expensive.
It got too expensive.
Sure.
Yeah.
Okay.
That's why you're here, is because you've been through this already.
My parents planned very, very well,
Yeah.
and it was very helpful, and other people in our family did not plan well, and it wiped them out, and it made a lot of stress and tension.
Got it.
So you know exactly what I've been talking about.
Right, but we also lost everything that my father owned all those years, so the hybrid definitely is of interest.
Yeah.
Because that was a lot of money.
Big chunk.
Yeah.
Okay. Any other questions? How we doing on time? 5 after. Okay.
So you mentioned something,
Speak up just a little so they can hear you,
you
please.
mentioned something about, death. So-
About death?
Yeah, like, the life insurance or something?
Yeah.
Does
Let,
life-
let me,
death benefit, yeah.
yes. Want me to elaborate on that a little?
Yes.
Yeah, okay. You buy the traditional long-term care insurance, right?
Okay.
And you pass away.
Okay,
Does anybody get any money?
No.
the traditional, no.
No, right? You paid your premiums, never needed long-term care, you die. You graduate to heaven,
Right, okay, like for death,
like her dad.
okay.
Does the insurance company pay anybody any money on your death? No, with the traditional.
Okay.
With the hybrid, it's different. Because remember, the hybrid is a combination of a life insurance policy, a special kind of life insurance policy, and a long-term care rider. What does that mean? It means if you die and you've never needed a long-term care insurance, the life insurance pays off to the survivor, your named beneficiary. Gets more money than what you put into the policy, tax-free.
So like the example he used is that someone put in $300,000, which was the lady with the $1 million. And if she doesn't use it, her children get $450,000.
And that's a death benefit. That's a life insurance death benefit.
So when, what did the $1 million?
That's the long-term care.
So it has two
that's
sides.
That's the long-term,
It really has two
So
sides.
it's $300,000 to have $1 million of care.
Yeah.
of
You
care.
didn't use any of that.
No.
So that 300,000 turned to 450,000.
Yeah, it's basically 3 buckets. When
You
you,
got her 300 back and another 150.
yes, exactly. All tax-free.
Okay.
So basically the hybrid, think of it as 3 buckets. When you reposition this money, you create 3 buckets of money. You've got the cash bucket, right? The money you put in there, which is not growing, as I mentioned. That's your cost. Okay?
To the insurance company so they can pay for the benefits.
Exactly. So they can create the other 2 buckets. They can create,
Hopefully,
Hopefully, yeah.
hopefully.
the second bucket is the life insurance bucket. And the third is the long-term care, which is bigger than the other 2.
Did I see on one slide that you can take your current life insurance policy money?
If you have cash value in it, if it's a whole life type or a universal life policy, I have a lot of clients who've done that. They have a whole life policy with cash value in it or a universal life policy with cash in it. The law allows you to take that cash, whatever's in there, and transfer it into the hybrid policy, tax-free. So I've had a lot of people who've outlived really the need for the big whole life policy, universal life policy, and so they transfer it over to the hybrid. They've still got some life insurance, not as much as they had over here, but the cash that was in the policy, right, transfers over to the hybrid. And maybe that's sort of a beginning lump sum, and then you add some additional money if you wanted to it. I've had a number of clients do that. Right,
So let's just say that she did start tapping into that $1 million.
right.
How does that 300,000?
Good question, good question, good question. So what happens is, did you all hear the question? Okay. What happens, the first thing that happens is the insurance company is going to use the amount of death benefit was 450 in the example we gave. They're going to use that up first. Okay, so they're going to pay out let's say they paid out $450,000 in long-term care benefits, right? And then she passes at that point. She passes at that point. That's used up the $300,000 that she put in, and the death benefit has been used up. So that's the end of the deal at that point. So it always comes out of the death benefit first. And then of course, if you need more than that 450, the additional 600, somewhat, 550,000 would be paid out as needed.
It's kind of like, it's like a mortgage, you pay the interest first. So there's,
Kind of like that, yes. Yeah.
Great analogy.
Good analogy, yeah.
What's the minimum amount for the hybrid?
25,000. 25,000 is a minimum.
And what would that,
Not much. Not much. It depends.
Well, if you were gonna spread it out.
Well, 25,000, if you're going to put it in a lump sum, it's not going to generate a lot of.
No, I mean, if you did the 25,000 or whatever in periods of time, to build it up to what your goal is.
Oh, sure, you could do that. Absolutely. Oh, yeah. You mean 25,000 a year?
I just wondered what the minimum amount.
25,000. Yeah.
So 25,000 doesn't give you much.
It's not going to give you no, because it's not much money you're putting in. I know it sounds like a lot,
Right.
but it's just not. Yeah. But if any of you are ever interested in finding out with what a situation would be for you, if you're just even vaguely interested, email me. What I'd need would be of course, your names, dates of birth, names, dates, I guess that's really it. Yeah, names and dates of birth, state that you live, I assume you all live in Virginia.
Are you licensed in other states?
There are a lot of people who come to this church that don't live in Virginia. They come from West Virginia and other places. So I'd need the state where you live. Those three, and I can run an illustration, no cost or obligation to you, I'll just email it to you. And then if you're interested, you could call me and we'll go over it together on the phone, and you could see what makes sense. And see if it makes sense. You just pick a number, say, look, Mike, I'd like to reposition over the next 10 years, reposition $50,000 into a contract. Here's my name, date of birth, and the state I live in. I'll run the illustration, send it to you, we'll see what it looks like. It'll show you the 3 buckets, and how much is when you get it back and all that. So that might be a good way for you to find out, because it's one thing for me to talk in generalities like this. It's another thing to see actual numbers. Be happy to do that if you're interested.
is the average value for the hybrid?
Pardon?
Plan, the average value for the hybrid plan?
What do you mean?
Insurance value, healthcare value?
You mean the long-term care value?
Yes.
Oh, no.
It's not $1 million for everybody.
Oh, no. I'd say probably the average might be 300, 400,000.
3 or 4.
Yeah.
A reasonable target. And that's based on the actuarial.
Yeah, you're asking me to make a generalization.
No, I know,
it's
but
a wild guess.
I'm just asking your opinion. And
Yeah.
your experience, that's all.
Yeah. I'd say the average benefit is probably 300,000 or 400,000 out at age 80. By the time it grows with cost of living, the benefit will be 300,000 or 400,000 as opposed to $1 million. So,
So if you have a person that's 35,
yes.
obviously it would be beneficial to sign up now or to
Well,
purchase now or no?
A lot of people do because they realize they can have it all paid up well before they really need it, right? So and if you want to spread it out over, say, 20 years or 25 years, right? That's less amount going in each year.
Right.
So rather than waiting till you're 50 or 60,
Right.
then you'd have to put more money in over a shorter period of time. So yeah, a lot of people consider that. Just don't, as I mentioned several times, don't reposition money that you need.
Because you need, right. Well, I asked that, okay, so this person has had cancer before already,
Probably won't qualify.
not at all, no,
But here's,
no matter how long.
well, I don't know. I don't know that. Remember, this lady had a stroke and she qualified.
Right,
Remember?
right,
If you know of someone who might be interested, you could email me. Better yet, call me, and what I need to know is what type of cancer, the onset, when was it, what's the prognosis, what medicine is she, that kind of thing.
gotcha,
And if you're interested, you could either email me with that information or better yet, call me so it's not over the internet.
okay,
Give me that information. I would then call the insurance company and say, look, without a name, without giving a name, here's someone interested in the hybrid policy. And here's her situation. She had cancer 5 years ago and so on. Would you consider her, yes or no? Or him, whoever you're talking about. And they'll tell me. Then I'll tell you. Okay?
So along those lines, there's stuff like surgery, there's pre-existing conditions.
Yeah.
Such as I have a neurological condition.
Right. They take a look at all that.
So that actually factors into all that.
See, that comes in with the interview, this 45-minute interview with the nurse. They find out all that past history,
Right.
pre-existing conditions, all that. And that's when they take that to the doctor at the insurance company, and he makes a decision. But we could do it sort of a preview before going through the full-blown interview. If this person has a certain situation that you feel might be a problem with the insurance company, and cancer certainly sounds like it might be,
right,
get me the details. I'll make a phone call anonymously without mentioning your friend's name. Right, and then get back to you. Okay, it's 8:15. I think we're running up against the clock here. Any last questions?
What if you're over 65 and looking at a hybrid? Is that gonna be like, it all depends on what you wanna reposition, basically.
Exactly. It really does. It really does. At 65, you may have to reposition more than, say, at 50 to get the same benefit. So that's why I'm saying, if you're really interested, let me run an illustration for you. Yeah.
And then to do that, you would want to send an email with just the
Email, or you could even call me with the information. I'd call you back. You have my information.
I took a picture.
Okay, good. Thank you all for coming.
Thank you so
You've
much.
been a great audience.